Hello and welcome to Morningstar. I'm Emma Wall, and joining me today to talk about ETF's suitability for these volatile markets is Mark Fitzgerald, Head of Product Europe for Vanguard. Hi Mark. So we've just heard from you at the Morningstar Investment Conference about ETFs and about the volatility that we're experiencing in markets at the moment. And there is a school of thought which suggests that ETFs are actually contributing to this volatility. What do you say to that?
Well, it's important to remember that the vast majority of ETFs are actually index vehicles. 99% are index vehicles. 91% in the European space are UCITS regulated. That means they follow the same diversification rules and regulations as other mutual and pooled funds. And ultimately, what most of those products are designed to do is give you exposure to the broad market. The benefit of an ETF is you trade once and you gain this exposure to hundreds or maybe thousands of securities. And at Vanguard, what we would say is we value long-term investing. We see the benefit in sort of setting your objectives and being disciplined. And to a certain degree, the day-to-day noise of volatility is not to be concerned. You shouldn't concern yourself with it because you should be thinking long-term.
I suppose they also add liquidity, don't they? Rather than a lot of volatility is caused by inaccessible markets, people investing sentimentally because they're scared that they may not be able to access certain assets. Whereas ETFs, because of the nature, because they are traded like a stock on an exchange, actually add liquidity to markets which probably need it.
Yeah, that's a very good point. So, fundamentally, an ETF is a wrapper. It trades like a stock. It's a fund, and it's a function of the marketplace. It's a reflection of the marketplace. That's why you buy it, and so it doesn't create volatility. It reflects the market. Now, what it does do, and what they do very successfully, is they add a layer of liquidity. And by that, what we mean is that if you look at the most traded ETFs, both in Europe and the US, 99% of the trading is secondary market trading. So that's investor to investor. The fund assets are not touched. And that's quite different from mutual funds. So that's another layer of liquidity, and that can help in volatile markets, and it can help in times where there are liquidity concerns because of that, the structure of them. It's a benefit.
So we've declared the product not guilty, but what about the investors? Because there is evidence to suggest that actually ETF investors hold investments for shorter period of times than perhaps active management mutual funds. And because of this speculation, because of this, the nature of which they're investing, actually they're at risk to crystallize losses because they're dipping in and out of the market, they're increasing trading costs themselves. And as we all know, market timing is incredibly hard to do. So how do we manage that element?
Yeah, again, it's a good point. And Vanguard doesn't, because of its buy and hold nature and the advice, we don't advocate market timing, incredibly difficult, if almost impossible to do. The nature of ETFs is that if you look in the US, which is much more mature, much more developed marketplace, the split between retail and institutional is about 50-50. They had their equivalent of RDR, before us. Now, what we found is that the concentration on costs is we would expect there to be over time greater emphasis on index funds and ultimately ETFs in the retail market. At the moment, though, in Europe, you could say maybe 85% of AUM in ETFs is held by institutions, and so they do have different trading patterns. Now, many of them are buy and hold. They're big, institutions, sovereign wealth funds, that type of thing, and they have a buy and hold nature. But there are some of the market participants who will use them for more tactical purposes, and that's part of the flexibility that an ETF offers. But you don't have to use it like that, and we wouldn't advocate using it like that.
And I believe your founder, Jack Bogle, has said often that people need to vote with their feet, and indeed that they have done in America, because fees are the only reliable predictor of future returns, and so unless active management comes way down, people are going to just move across to ETFs.
Yeah, and that's the thing. That's one of our key messages. The discipline, the long-term nature, buy and hold, and control what you can control, i.e. costs. And the more participants you have, the more product that begets competition. You've seen price compression. You've seen it in the US. You've seen it in the European space, in the UK space, in mutual funds and ETFs. And we would expect to see that continue. And that's to the benefit of investors because of the nature of the impact that costs have. Every little you save compounds over a long period of time.
Mark, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.